Well, I always tell my customers, put yourself in the insurance company's shoes, right?
Yeah.
You're buying a 100 unit building. It's got a replacement value of $6 million, right? Let's just use that. Would you want to insure the building? Would you want to put up $6 million to insure the building based upon the information that you've given me?
Welcome to the Bulletproof Cashflow podcast. Let's get into the show.
Hey everyone, this is Agostino. When we're rushing to do our real estate deals, insurance is one of those things we need to be looking very, very closely at. We need to be very proactive when it comes to making it a priority to get the right policy before it's too late to solve a major issue, like say a fire or some other bad thing that happens at a property. Well, today's guest understands the importance of insurance planning for multifamily, commercial, and other policies as well. As a co-founder of Maconachy Stradley Insurance, he and his team insure thousands of units across the U.S. His focus is on helping real estate entrepreneurs mitigate risk when owning and managing large real estate deals. Now, with all that, I'd like to welcome Drew Maconachy to the show. Drew, thanks for coming on, bud.
Agostino, thanks for having me. That last name's a doozy, isn't it?
It is. I thought my name was kind of crazy, but
yours is easy. Come on.
You know. But well, hey guys, if you like what Drew has to say throughout this interview, feel free to check out their website at maconachystradley.com. All right. So Drew, maybe go ahead and tell us a little bit more about you and what you guys do to help people with their insurance needs.
Sure. Yeah. So we call ourselves consultants, right? Which I kind of hate that term, but it is truly what we do. My job is to take information that's given to me by my customers, risk tolerance levels, so on and so forth, a million different factors. Risk tolerance is a huge one, and create a tailored program based upon their needs. A lot of people stop at the lender requirements, right? It's a great example. They say, Drew, here's the lender requirements, meet those and give me the best quote. Well, the problem with lender requirements is they are protecting the interests of the lender. That has nothing to do with protecting your equity as a real estate investor in the deal. So my job is not to protect their needs, it's to protect your needs. Obviously, by protecting your needs, I'm going to protect their needs as well, because your needs are above and beyond their needs. But it is not just I try and make it more of a consultative process where we're going back and forth. Here's what I need. Here's the amount of a risk I'm willing to assume, and give me your best quote based upon that, right? It's not, give me the cheapest deal based upon lender requirements. Let's go. Like I try and step back for just a little bit, say, all right, I get that. I'm going to get you the best deal I possibly can. There will be no fat in the deal based upon what you tell me, but we can't just strictly stop at the lender requirements, because that's not me doing my job for my customer.
Right. Well, hey, you know what though? That's the thing. I think that for many people starting off, they see the bank requirement just to get into a deal is 1.25 DCR, debt coverage ratio. 1.25 is all you need. And the person borrowing the money who might be just starting out, they're saying, 1.25, that's the minimum. I meet the minimum. That's great. I'll just go ahead and do the deal. But what they don't realize is that minimum, just to your point, only covers what the lender wants and needs. They don't really care about how much money you're going to make off the deal. So 1.25 as an example, 1.25 is enough just to cover the debt coverage, to service the debt. That's it. After that, they don't really care if you make any money or not,
Yeah, exactly. And you're holding the bag. So
you're holding the bag, right? So they don't know what your business plan is. They don't care what your business plan is. They're worried about their business plan. But you're 100% right. When it comes to insurance, they're only looking for the minimum coverage. And to your point, there's a lot of things that are often missing from that. I mean, it's funny because when I first started in this business, I used to hear about units burning down or complete buildings burning down. And I'm like, that's never going to happen. How often does that happen? Well, come to find out, I've already had 3 buildings have had these issues, right? So I don't know if I should admit that on a podcast, but it does happen. When you have thousands of units, it's bound to happen. Something's going to go down. And how do you know? How do you counsel people to make sure they have the right sort of coverage?
Wow, is that a good question? How do you know? You start at the beginning and you have a long talk about what do you have? I mean, I get a sheet filled out, like we call it a statement of values. It's a sheet that's going to tell us, what is in the building, what's around the building, how many square feet it is, what type, is it frame versus, we call it masonry non-combustible. That's another word for brick or concrete exterior. All of those different things go into us being able to put together a program for our customer. The more concise that information is, the more I can spin it in a positive light for my customers, to my underwriters, thus getting them a better deal. So I think there's a lot of times where I frustrate customers that say, come on, I'm just trying to jam this deal through. Give me the best quote. Well, I'm in kind of a tricky situation there, because the more questions I ask you, the better deal I'm going to be able to get you. So my best customers, the best rates that I get from my customers are the customers that kind of take a step back and they answer the questions I have. I promise you, your agent or me doesn't ever want to waste your time, because that's me spending my time too, right? I'm not asking questions, to get you to spin your wheels. I'm asking questions to get you a better deal, period, end of sentence. So take the time. I promise you, nobody's asking questions that don't need to be asked. If I'm asking a question, it's because I've been asked that question, or because I've done it enough times that I know that question is going to be asked, and I'm trying to get ahead of it.
Yeah. Maybe, you know what, and this might be helpful. Maybe if you spend like 30 seconds really talking about it at a very high level, how does it work in terms of, I'm going to go buy an asset. You want all the information from me. Then what do you do with that? I mean, I already know you shop it with certain I guess, underwriting companies that have an appetite for certain assets, right?
Yeah. So that's basically it, right? You're out, you're doing your due diligence, and I actually have a due diligence checklist that we can somehow distribute to your customers or your listeners if you'd like. But it puts together the information that every insurance company is going to require. It's not a request, it's a requirement, right? And if I don't get them that information, they decline the deal and they move on to the next one, right? Our customers are not the only ones who are getting deals quoted. The rates are up right now. I don't think that's a shock for your customers to hear, your listeners to hear. So everybody's out there shopping. There's a million deals that underwriters are looking at. They don't care if they win your deal or not, right? They want to work on the deals that they either have the best chance to win. And that's my job, is to tell them, hey, you've got a good chance to win this. If here's where you need to be to win the deal. They want to see that, right? They want to see a target premium, and they want to see good underwriting information. So every time I talk to somebody new, they say, what do you need? What information do you need? I send them a checklist. I say, this is it. Get me this information. It's a one pager. Once I have that, I shouldn't bother you again, unless there's some ancillary questions that either were answered incompletely, or kind of one question led to another.
Yeah. And I think it's also important to note too, is that this type of insurance is not like car insurance, right? You just call Geico and save 15 minutes to save, $1,500 on car insurance or whatever. It's not like that. And I think that that probably happens a lot, where people seem to think that, oh, it's as simple as just making a phone call. I mean, it gets very, very competitive. To your point, there's a lot of deals out there, and insurance companies are being somewhat careful, right? Maybe is the right word, as to who they're investing in, and they want to know a little bit about who owns the asset too, and who's going to be managing the asset. All those things are very, very important. But I guess.
Well, I always tell my customers, put yourself in the insurance company's shoes, right?
Yeah.
You're buying a 100-unit building. It's got a replacement value of $6 million, right? Let's just use that. Would you want to insure the building? Would you want to put up $6 million to insure the building based upon the information that you've given me? That's a great tool, right? As you're getting frustrated with your agent asking you more questions, say, if I was in the insurance company's shoes with the amount of information I've given them, would I want to insure the deal?
That's right. And if you think it's no, you're going to have a problem.
Yeah, exactly. Yeah, your rates aren't going to be good.
That's right. That's right. Now, what would you say is the best type of insurance to obtain on these sorts of commercial assets?
Yeah, so everybody needs some basic policy types. Probably all of your listeners have heard them, right? Property coverage is probably the biggest point of pain. It's certainly going to be a real estate investor's biggest insurance purchase from a cost standpoint. That's going to cover the physical asset itself. It can cover the contents of the building, so any appliances that you have. If you've got a workout facility, if you've got a pool area, any of those things you can get covered under the contents portion. And then it's going to cover your loss of rents if there's a covered loss, right? So a tornado comes through, it rips off half the building. You've got 50 of your 100 units down. The loss of rents coverage is going to kick in, pay you what your rents would have been had you not had the loss until the building's made whole, right? That's your first policy. Second, very common policy is a general liability policy. It is going to protect you from lawsuits from your tenants or from the public. So most common cause of loss there, slip, trip, fall, or dog bite if you have dogs, if your tenants have dogs. But slips, trips, falls are by far the most common, where a tenant or one of their buddies falls down the stairs. They say, that stair was loose, or the floor was wet. You didn't properly maintain your building. We're going to sue you. Those are the two most common. Next, probably 50% of real estate investors buy it's an umbrella policy. All an umbrella policy does is sit on top of your general liability policy and add limits to it. Meaning if you have a general liability policy with $1 million limit and you buy a $3 million umbrella, now you have $4 million of coverage on that general liability policy is how it functions. So big, bad, ugly claims that would have burnt through your general liability policy, now you have coverage up to that limit. So obviously the bigger assets you buy, and again, a lender is going to kind of hold your hand with this because they're afraid of a suit taking you down and making you not able to service your debt. So they'll help you with that. But that's kind of the third most common policy. The fourth and fifth, almost nobody buys, but I think they're big gaps in people's. I think they're self-insuring all that exposure that they don't know that they have, right? And the first one's directors and officers coverage. If you are raising money from investors to buy a building, that's not going, if they sue you for underperformance or malfeasance, that's not going to be covered under a general liability. You have no coverage for that unless you buy a directors and officers policy. Because that directors and officers policy is meant for you and any other of your partners. You know, if it's a partnership, GPs, LPs are going to be covered under that. If you are managing the building and if there's claims of mismanagement, if you are intentional loss, right? It's not going to cover you if you're defrauding your customers, but other than that, it's going to pick up coverage. So it's a huge, I think, gap in a lot of people's risk management plan is not to have a directors and officers program in the event that you are collecting money. If you're using your own money, no problem. You don't need it. And then the last one is pollution coverage. It's a weird way to say it, but that will buy back coverage for fungus and mold. That's the big one. Legionnaire's disease is another one that has been known to get up in the vents and it gets spread. So it's going to cover back. Right now, COVID, there's a lot of fights in the courts over pollution coverage and COVID because it kind of buys back virus and bacteria coverage. So had people had pollution coverage, it's probably 5% of people buy it because it's expensive, but it would have been a way for you to have at least an argument for COVID-related claims.
Right. Well, that director level policy, that is actually quite interesting because even though we as syndicators, we get out there, we raise money for deals, we disclose everything about the asset, and typically we perform. We always perform. We only get into deals that perform. But if there's someone that you maybe you let them in on a deal, and they don't really understand how this stuff works, and maybe they don't really understand that the first 6 months, for instance, there are no returns in the first 6 months while you stabilize the asset, and then you start delivering returns after that. Maybe they just don't want to hear it. Then what do? Now you got a lawsuit on your hands because they decide they're going to call the SEC and deal with all that. That part is huge. I mean, it doesn't happen very often, but when it does happen, you want to be ready for it. You want to be protected. Sounds to me like that's a wise thing to do.
And I would argue that it's more important not for any sort of potential settlement that comes out of it. It covers your defense costs. So it will cover you to go buy an SEC lawyer to defend you from what could very easily be a foolish claim, right? You did nothing wrong. You laid it out clearly, but that doesn't stop anybody from suing you for any reason they want to. And you're going to have to defend yourself, period. They're not going even just to get the case thrown out. It's going to cost you $5,000 in attorney's fees just to say, well, we want a summary judgment based upon facts on the table. That's going to cost you $5,000. Do you want to pay $5,000? No. And you could pay it 50 times if you have 50 investors. So, and then the problem is you lose one of those. One investor gets a settlement, and guess what? Now you got some more investors coming after you. So you could get 50. All of your investors on one deal come after you. So, we've had such a good environment for real estate investors for the last, 5, 6, 7, 10 years now. We've been on such a good run that very few people are getting sued because everything's performing. But man, if the market takes a turn, it goes against expectations and you get caught in a lot of bad deals, suits are going to go through the roof. And the coverage is cheap because it's a function of how many claims the insurance company's paid versus premium they've brought in. They're making a lot of money on directors and officers policies. So the coverage is cheap. When coverage is expensive, that means the insurance company's is getting killed. So when it's cheap, that means the likelihood of a claim is low, but that can all change in a minute if the market changes.
Hey, Agostino here, and I would love to connect directly with you. Text the word books to 202-410-4202 to receive weekly book recommendations from me.
That's right. And I mean, it's one of those things that actually there's a syndicator that I know. He held back the returns from investors at the beginning of the year when all this COVID stuff happened back in March, right, of 2020. He held everything back, and he has unaccredited investors in there in some of his deals, and unaccredited, unsophisticated too, which I mean, he's taking a heavy risk to take these people on to begin with. And next thing you know, they're kind of like freaking out because they're worried about their $5,000. It's all you need is to have one of those guys make one phone call to the SEC, and now you're all wrapped up with that. So that's the last thing you need. Yeah, for sure. No, it's definitely something that if you're listening to this, at least ask your insurance carrier about, or just call Drew. Of course, that's another option. You could do that too, right? Yeah. Now, one thing that you mentioned too was loss of rents. I mean, I touched on this earlier, but when usually for whatever reason, a lot of fires, especially in those seed type of class assets, it seems to happen a lot more with those. I'm not sure why. Maybe it's the clientele. I'm not sure. But if you're out a handful or even a whole building of these, and you're out all that income, it could be rather painful, right? Because you still have to pay the mortgage on that thing, whether they're there or not, right?
Yeah, correct. That's exactly right. Yeah, your expenses aren't going away just because you have a loss, right? The bank isn't going to feel bad for you. So loss of rents coverage is very important. There's a couple different ways that it gets worded on a policy. The words you want to look for are actual loss sustained. ALS is the acronym for that. And that means the insurance company will pay you the actual loss that you sustained instead of it being a specified limit, right? Instead of it saying $1 million, we're going to pay $1 million for business interruption or loss of rents, business interruption, business income. They all mean the same thing. Instead of capping it at a certain dollar value, we'll pay you the actual loss. So it's it really doesn't cost anything extra. It's just it's better policy language that you're going to want to see on your policies. But you're absolutely right. It's a coverage that I would say is a must. It's not that expensive, and you can have this great building. You can have 100% occupancy, an unbelievably well-performing asset. You forget to buy that coverage and you get 3/4 of your building burnt down. Your occupancy now looks like it's 25%. And if you had this coverage, you'd still have 100%. So it's a very important coverage.
Yeah. Yeah, absolutely. I mean, we actually had that coverage on one of our assets, actually more than just all of our assets. And it has definitely saved us on on those assets for sure. Especially when you're talking, 10, 15 units, that adds up. That's a lot of money to be out for however long it takes to fix. Well, in our case, we're just fixing those units, but if it burnt to the ground, it would have been toast. It would have been very bad. Now, now, what do you do in the case of, like, say, assault and battery or anything else like that, where there's someone is hurt on a property, whether it's a dog bite? I'm not sure if it's going to be the same thing, but where there's some sort of injury. Like, how's a landlord liable for those things?
Good question. In the eyes of the law, and I'm not an attorney, so I shouldn't get too into this, but I see this stuff day in and day out. You as a landlord are responsible for creating a safe environment for your tenants. Is it reasonable to expect you, if there's a fight within a unit, to have any way to do anything about that? No. But again, you're going to get named in the lawsuit because your tenant thinks that you have the deepest pockets. It's the deepest pockets rule. That's how insurance and the law always works. So they're going to attach you to a claim and try to get you to settle out. I'm really glad you brought this up, because this is a change in the marketplace lately, where on, I would say, B minus and below class buildings, assault and battery coverage is now either being sublimited, meaning instead of offering that full GL limit of $1 million with an umbrella on top of it, they say, we'll give you up to $50,000 or up to $25,000 of coverage. And then anything over that, we're off the deal, right? We don't want any more of that. The reason for that, as you probably can tell from what I just said, is they've been getting killed on assault and battery cases. They're getting drug into 1 million lawsuits, and they don't want to insure it anymore. And the whole market is kind of moving in that direction. So it's a good differentiator if you're really going through the underwriting process and looking at policy terms. Take 2 minutes to look at the policy terms and make sure there's an exclusion list on every policy. Look at that exclusion list. That thing is worth its weight in gold, because it's going to say exclusion, lead paint, exclusion. It's going to go through all of it. Unmanned aircraft is an exclusion on everything, right? It's stuff that people don't even think about. But then it's exclusion, assault and battery, or sublimit, assault and battery, 25,000. It's a good summary of the coverages. It's like a table of contents in a book. But you'll be able to get a lot of information by taking 25 seconds to read that page.
Yeah, well, that part is absolutely huge too. I think even more so the dog bite scenario. I mean, we acquired an asset recently, several assets recently that had pets, right? So I'm not a big fan of the whole pet scenario, and especially as much as I'm probably gonna make a lot of haters on the show, but I mean, I'm not a real big fan of having a big dog in your small apartment. It's not good for the dog. It's not good for the neighbors. It's not good for anybody, in my opinion. But whatever. But one thing that we had in one of our assets was this person had like 2 pit bulls in the small apartment, and these pit bulls were very, very how should I say, angry all the time, right? And they nipped at a few tenants, and they're very loud too. So it's like, clearly in a case like that, if something happened, then I would be liable, right? And I mean, we had to do something about it, So,
well, first they're going to try to sue the person who owned the dogs, right? But that person is living in a B or C class unit. They aren't probably going. It's, it shouldn't stereotype, but they probably don't have as deep of pockets as the asset owner. So again, the dog bitee, that attorney is going to go after the landlord and say, you should have never, these were aggressive dogs. You should have never let them on the property. And guess what? You're going to lose that one. So not only are you going to pay defense costs, but you're going to pay a settlement as well. So this is kind of a tricky question, right? Because now it's a good recruiting tool to get people in your doors, right? To allow pets, but it can screw up your insurance costs as well. So where do you level out? What I always tell people is there's 5 dog breeds, typically speaking, that are kind of on the no-no list with insurance companies. If you get rid of pits, if you get rid of Dobermans, Rottweilers, German Shepherds, and Chows, those are the, can't believe I did that quick. That was, pat on my back. If you can write into your lease, you're allowed to have pets other than those. That'll go a long way when you're going through the insurance procurement process. I don't think it's the end of the world. As an insurance agent, I don't see it moving price a bunch unless you have dog bites. If you have a couple dog bites or maybe even one bad one, then it's good to show the insurance company, hey, we're trying to do what we can to make our facility safer. We're now outlawing dogs. But I just don't see I think that I think you're going to lose more potential tenants by not having dogs allowed than you are by than the money you're going to save by not having pets in your property. Does that make sense?
Right. Yeah. Absolutely. I mean, and you know what though, even if you do outlaw dogs on your property, even if you still have the insurance, you're still better off just in case they do sneak one on, because it does happen too from time to time, right?
Yep. And again, that's if you look at that exclusion page on your general liability policy, you're going to be able to see if if pets or dogs are going to be excluded.
Right. So I'm sure many people are thinking about, well, wait a second. So when I do get all this insurance, is it insuring me, my LLC? Is it doing both? Like how does insurance, how do you insure the property, I guess, using an LLC or personally, or how does that part even all work?
Sure. So however the building is titled, that's how you want the insurance policy, the first named insured, right? When you see your declarations page, the first page, you want however the building is titled, you want that name to show up right there. If there are, let's say you have 3 investors that are investing money through their LLC, they should be asking you to be listed as additional named insureds on the policy. That's not going to show up on the front page. There will be a schedule further back in the policy where you have that. But if you're in an LLC, you've got protection legally, right, from the building. So as long as you have the insurance policy saying the LLC, you as the owner of the LLC will be fine. That's how you want the insurance policy to read. You just don't want to buy the building in 123 LLC and then be insuring it as in the personal name of Drew Maconachy, right? That's not what you want to do. However it's titled is how you want it to be insured.
Excellent. Yeah. I mean, there's so much to the insurance game that can really help you, but also even save you a bunch of money. Actually, there is an asset, Drew, that we bought recently. It had these Zinsco breakers. Now, apparently, Zinsco is one of these ones that the breakers were deemed unsafe a long time ago. And so we had to. Currently they're paying like triple of what we'd pay on a tower. Like the insurance company was charging the previous owner. So we went in. We have our insurance on there, which is far less, but still expensive. But by us spending the money to upgrade all that, to fix all that, get rid of all the fuses, upgrade all the electrical, we're going to save a ton of money on our insurance. It's going to be huge, and we don't have to worry about any fires or any other type of issues like that too. So it's sometimes worth spending the money to fix those issues, just on the money you save on insurance too, right?
Agreed. Like net, a lot of times it makes sense to do the upgrade because your insurance costs will go down $20,000 and it costs you $15,000 out to do the fuses. Zinsco is one. The other one is Stab Lock. It's Federal Pacific. name, and the actual bad breakers are called stab lock. They're both major no-nos. And again, those are going to likely be excluded if you have it. So what I always tell people is be very forthright with your insurance agent, right? Tell them everything and then let them determine how to put lipstick on your deal when going to the underwriters. But if you don't tell me stuff, if I don't know that you have Zinsco breakers, I'm not going to even be paying attention to the exclusion on the policy because I was never told that you had it, right? So, we're the insurance experts. Arm us to help you. And we're on your side, right? Think of us as your attorney. You're going to tell the attorney what happened and then let them spin it in your best light. Exact same thing goes for insurance agents.
Yeah, that's right. Well, and that's 100% true. This is not one of those scenarios where you're trying to hide things from anybody. I mean, you should never try to. You should always be transparent with business in general. It's just what I do anyway. But if you tell the insurance company everything, if you have aluminum wiring in your place, tell them you got aluminum wiring in your place. You're gonna have to deal with it. You're gonna have to fix it. You can't leave it there. If you have Zinsco breakers in there, tell them, because the last thing you want to do is have a fire, and then because of these breakers, and then you have to fight that because they can turn you down if you do. Right? Yeah, and they will. Yeah.
Oh, in a heartbeat, they will. I mean, it's an insurance policy is nothing more than a contract. We are assuming this risk, and I say I'm not the insurance company. It's important to note that my customer is a real estate investor. My customer is not the insurance company. So the insurance company they have every right, based upon the language of the policy, to deny claims. And if there is a aluminum wiring exclusion and you have a loss, that's the cause of that loss was the aluminum wiring, it's going to be declined, and you're never going to win that case in court. So it's hugely important to pay attention to the product that you're buying.
That's right. Absolutely huge. Absolutely.
It's not standardized. In this market, in the apartment building or single family rental market, the policies are not standardized. To go back to your example before of Geico versus State Farm versus, blah, blah, blah. Any of the insurance companies on personal lines is what we call it. A lot of those policies are highly standardized. So price is, here you go. You're going to get me to say price is kind of the determining factor, but it is, right? On personal lines, price has it should have much more to do with your procurement process than coverage, because the coverage is relatively standardized. When you get into buying apartments or single family rentals or mobile home parks, the policies are so different, so non-standardized that you have to pay attention, even in between your renewal period. The insurance company could have got hit with 10 assault and battery claims in your region, and they say, okay, we're going to sublimit assault and battery now. You just need to take 5 minutes again at the time that you buy the policy and pay for the policy and look over it. And I promise you, if you do that, you're going to find some stuff that really surprises you if you hadn't done that in the past.
Right. Absolutely huge. Never skimp on this part, guys. All right. So Drew, if you had one piece of bulletproof advice, what would you tell that person listening right now?
Engage your insurance agent early when you're going through your due diligence on a new building. Don't wait until the end. Once you have a letter of intent, if you know that you're going to buy the building, or if you're very confident that you're going to buy the building, right then engage your agent and have them tell you what they need. Give them as much time as you can to get you the best quotes possible. There's like 100 insurance companies that play in the space, but a lot of them are, like I said, they're underwater because they're getting a ton of deals because rates are up. So we want to get them a really good submission, and we want to get it to them as early as they can, because they are going to pay more attention to that. It's an imperfect world, right? So empower your agent to get you the best rates possible. And on the flip side, if you don't do that, don't expect awesome rates.
Right. Get in there early. Get in there early. Great, great, great. So if someone wants to get a hold of you, how should they do it? What's the best way?
Yeah, so I would say the phone. I'm a big phone guy. We run a lot of deals. So if you want to call the office, it's 330-966-5170. I'm also very active on social media. Facebook is probably the best platform to find me at. You'll see I do it under my personal name. My company has a page as well where we put up a lot of videos, a couple videos a week on different topics related to insurance. They're usually they come out of frequently asked questions. So it's probably something that you're thinking about or maybe is in the back of your mind. And they're good little reminder videos to pay attention to kind of hot topics.
Excellent. Excellent. All right, guys. Well, definitely reach out to Drew for your insurance needs. And it's important to mitigate your risk personally as an entrepreneur, but also the risk of your investors. It's a real big part of it. So definitely make sure you got the right coverage in place to help really cover yourself, right? It's a big part of doing business. Take care, guys, and I'll see you in the next episode.